Building wealth isn't some glamorous overnight jackpot. It's a long, winding path that only starts to bend in your favor after you cross one critical number. And no, it's not $1 million. It's not even $500,000. It's $100,000. Hit that number, and suddenly the rules of money start working for you instead of against you. Most people approach wealth building like climbing a mountain. You work hard, you save, you invest a little here and there, but the summit always seems too far away. The slope is steep, the air gets thin, and every small step feels like it barely makes a difference. But once you cross $100,000, everything changes. It's like reaching the top of the hill and realizing gravity is now on your side. Let's rewind to that first stage of compounding. It's the most brutal part of the journey where most people give up. You're disciplined, putting money away, yet progress feels like watching paint dry. You invest $10,000 and get $600 in returns. It's easy to look at the numbers and think, what's the point? Compounding can feel like a myth at this stage. After you hit $100,000, everything changes. Earning 6% on $100,000 means earning $6,000. It's not just growth. It's growth on top of growth. Your money works harder for you. This is where the magic of compounding stops being a math problem and starts being a force of nature. Suddenly, your money feels alive. It's multiplying on its own. You're no longer pushing a boulder uphill. You're standing on the slope, and the boulder is rolling forward with its own momentum. And that feeling? It changes everything. You become more patient, more disciplined. You stop touching your investments because now you see what they're doing. It's the difference between trying to push a car and sitting behind the wheel with the engine running. But if it's that powerful, why do so few people ever reach that point? The short answer, psychology. The long answer, everything in our world is designed to keep you from getting there. The first obstacle is lifestyle creep. You get a raise, and instead of increasing your savings, you increase your spending. Suddenly, basic needs now include $7 lattes, free streaming services, and Uber rides that cost more than the groceries you bought. It's sneaky. You don't notice it happening, but every dollar you could be investing is now funding a lifestyle that doesn't actually make you wealthier. Then there's distraction. One day, you're committed to index funds, and the next, some guy online is screaming about crypto. Then your coworker's cousin made $40,000 trading options. So you panic, pull out your money, chase the next shiny thing, lose money, and start over from scratch. Every reset pushes your timeline further back. It's like planting a seed, then digging it up every 3 weeks to check if it's growing. Add in the emotional roller coaster of the market. Red week panic selling, green week FOMO buying, and you've got a perfect recipe for quitting before the magic happens. Most people don't fail because they can't reach $100,000. They fail because they don't stay invested long enough to let compounding work its slow, boring magic. Here's the uncomfortable truth. Below $100,000, it will feel like nothing's happening. You'll wonder if it's worth it. You'll feel like the world is moving faster than your money. And that's exactly why most people quit. They stop digging just 10 feet away from gold. But the ones who make it, they keep digging. They endure the boredom. They plant the tree and wait for the forest. So how do you get there faster, especially if you're not pulling in a six-figure salary or sitting on an inheritance? The answer is surprisingly simple: offense and defense. Offense is about boosting income. You don't need to start the next tech startup or become a real estate mogul. You just need one skill people will pay for. Can you edit videos? Tutor kids? Write resumes? Bake cookies? Whatever it is, offer it to people outside your immediate circle. Do a few gigs, then raise your price. Suddenly, that extra $200 a month isn't just spending money. It's rocket fuel for your investments. Defense, on the other hand, is about plugging the holes in your financial bucket. Look at your last 30 days of spending. You'll probably find subscriptions you forgot about, bills you could negotiate, and purchases that didn't actually make you happier. Every dollar you stop wasting is a dollar that can start compounding for you. And the earlier it starts, the longer it works. There's also one weapon most people overlook: automation. The less you have to think about saving and investing, the more likely you are to stay consistent. Use roundup apps that invest your spare change. Set up automatic transfers the day after payday, so the money's gone before you're tempted to spend it. And when you get a raise, increase your automatic contributions immediately. If you never see the extra money, you'll never miss it. Now, let's talk numbers for a second, because this is where things get real. If you invest $250 a month, you'll hit $100,000 in about 20 years. $500 a month gets you there in 12. Push it to $850, and you're crossing that line in just 8 years. It's not magic. It's math. And math doesn't care about your income, your background, or your past mistakes. It only cares about consistency. Now let's say you've mastered the basics. You're investing consistently, trimming the financial fat, and maybe even bringing in some extra income. You're on the path, but you're still wondering how to hit $100,000 faster. That's where the real game begins, because there are two powerful levers that can dramatically speed things up: higher returns and stacking windfalls. Let's start with returns. And no, I don't mean throwing your money at the latest meme coin or praying a penny stock will go to the moon. Chasing big wins is exactly how most people sabotage their compounding before it has a chance to work. Instead, your focus should be on proven, diversified investments that have consistently performed over decades. Things like low-cost index funds. The S&P 500, for example, has historically returned around 8 to 10% annually. That might not sound exciting compared to someone's 200% crypto screenshot, but that consistency is the secret weapon. And here's something most people completely overlook: Fees. A 1% management fee might sound tiny, but over 30 years, it can eat away tens of thousands of dollars in potential growth. Keeping your fees under 0.25% and reinvesting your dividends instead of cashing them out might not feel like a big deal now, but those two habits alone can shave literal years off your journey to six figures. The difference between good enough and optimized investing is often the difference between hitting $100,000 in 12 years or hitting it in 9. The second lever, and this is where most people miss out, is stacking windfalls. Most of us treat windfalls like free money. Tax refund? New phone. Work bonus? Weekend getaway. But every dollar you toss into your investments early gets an extra year of compounding that no future contribution can replicate. Think about it. A $1,000 bonus invested today has 30 years to grow. The same $1,000 invested next year only has 29. That's not just an extra deposit, that's an extra year of growth. And those small decisions pile up. I'll give you a real example. Lou is a graphic designer making about $45,000 a year. Nothing flashy. But he decided to approach wealth building differently. Instead of trying to get rich overnight, he focused on stacking small wins. He picked up a few freelance gigs that brought in an extra $400 a month. Then he canceled his cable subscription, negotiated a lower car insurance rate, and found another $200 he could redirect each month. That's $600 going into his investment account, automatically, every month, no questions asked. It didn't feel like much at first. But 10 years later, Lou had crossed the $100,000 mark. And here's the kicker. Without adding another dime, that money doubled to $240,000 in the next 10 years. The snowball had taken over. It wasn't Lou pushing his money anymore. His money was pushing itself. It's about hustling long enough to let your money take over the heavy lifting. Once you cross $100,000, your financial life fundamentally changes. But there's another side to this story. The psychological traps that keep people stuck below $100,000. Money, for better or worse, is deeply emotional. One of the biggest traps is lifestyle inflation. Your expenses rise to meet your income. Many fail to build wealth because they spend every raise. Another trap is shiny object syndrome. You doubt your plan when tempted by the latest trend. Every reset robs you of compounding time. Emotional investing leads to selling during dips, then buying back at higher prices. Stick to your plan. Ignore the noise. Compounding is slow until it's sudden. Wealthy people stay patient during the quiet parts. Keep watering your seed. Growth will come. Automate your savings and investments. Consistency beats intensity. Each dollar is a tiny employee working for decades. Stop viewing compounding as a strategy. See it as a timeline. Early on, discipline is more important than immediate results. Measure progress by your contributions instead of the size of your portfolio. The results will follow once the habit is built. Imagine compounding as a snowball rolling down a hill. It starts tiny and slow, but eventually it becomes unstoppable. The best time to start investing isn't when you're rich, it's when you're broke and the stakes are low. Even if all you can invest right now is $20 a month, do it. It's about momentum and growth. The real freedom comes when your money works for you, allowing you to make choices and live your life fully. The first $100,000 is proof that you can build something from nothing and master the process. Start now, even if it's $5. That tiny step is how every journey to $100,000 begins. Subscribe, like, and comment below to share your journey toward financial freedom. Let's build a community together. Imagine waking up on the first of the month, and before you finish brushing your teeth, $4,000 has landed in your account. Not from your job or side hustle, but from money you already invested quietly in the background. That's the dream people chase when they talk about passive income, and ETFs are one of the cleanest ways to get there. $4,000 a month is $48,000 a year. To pull in that much from investments, you need a solid pool of capital. If your ETFs yield 4%, you need about $1.2 million invested. At 6%, it drops to $800,000. Push for 7 or 8% and you're down to the $600,000 range. The higher you chase yield, the more shaky the ride gets. That 8% option might look amazing until you realize it's built on shaky foundations. Finding the balance between yield and stability is crucial for peace of mind at night. ETFs are just baskets of stuff, some filled with dependable companies that pay dividends every quarter. Others are filled with bonds that hand over interest regularly. Some even include real estate or option strategies. You buy the basket, and it does the heavy lifting. One dividend cut doesn't tank your whole plan. The basket softens the blow and keeps your income steady enough to avoid panic during market fluctuations. One route is dividend ETFs. These are filled with companies that pay out portions of their profits as cash to shareholders. Think of them like reliable tenants who pay rent on time, except instead of a single tenant, it's dozens or even hundreds of companies contributing to your mailbox. Each dividend might feel small, but together they create a steady stream of income. Many companies even increase their dividends over time. Another option is bond ETFs. Bonds are essentially IOUs from governments or corporations, paying out interest regularly. A bond ETF bundles hundreds of these IOUs, spreading the risk across many borrowers. This results in a steady trickle of interest checks landing in your account. Blending bonds with dividend-paying companies builds a machine that can replace your paycheck. To achieve smoother cash flow, mix ETFs that pay monthly to cover rent, groceries, and bills. This ensures distributions come in every month. Some ETFs target monthly payers, giving you cash flow that feels real-time. This design detail separates vague investors from those with a solid income plan. Investing isn't just about percentage yield. It's about structuring your cash flow for your life. The desired money won't appear just because you want it. Starting small takes time and discipline. $10,000 in a 5% ETF yields $500 a year, about $40 a month. It's the seed of your investment journey. Many quit after seeing small returns, but every oak tree starts as an acorn. Time and consistency can turn that small investment into something meaningful. Think of your portfolio like a wall you're building brick by brick. The first few bricks don't look like much, but with each deposit, you're stacking higher. One day, you look up and realize the wall is tall enough to protect you, to shield you from financial storms, to stand on its own. You don't need fireworks, you need persistence. Picture it like climbing a mountain. The summit is $4,000 a month, but you don't teleport there. First base camp, $500 a month. That already feels like a win, covering groceries or utilities. Second camp, $1,000 a month. That's rent in some places, a milestone that illustrates your progress. Third camp, $2,000. That's your mortgage, car, maybe even a vacation fund, lightening your burden. Markets wobble. Dividends get cut in recessions. Inflation silently eats away at your buying power. Inflation means that $48,000 today won't feel like that 10 years from now. You need to aim higher. Taxes also mean that what you see on your brokerage screen isn't what hits your checking account. That's why you aim for a cushion. Risk management is vital. Don't put all chips on one high-yield ETF. That's gambling, not investing. Diversification matters. Spread across dividend ETFs, bond ETFs, real estate, or international ETFs. Diversification keeps your portfolio functioning even when one piece falters. Imagine running a restaurant where half your waiters are out sick. You keep serving customers because the kitchen still runs. Don't forget about fees. A 1% fee sounds small until it's scaled. On $1 million portfolio, that's $10,000 a year. Over 20 years, you could lose hundreds of thousands due to fees. They're the quiet killers of returns. Consider low-fee ETFs. Many charge as little as 0.05% or 0.10%. This can save you thousands. With low fees on $1 million portfolio, you pay $500 to $1,000 instead of $10,000. Imagine you've built up to $400,000 invested. At a 5% yield, that's $20,000 a year, or about $1,600 a month. That could cover your groceries, car, and part of your rent, making your job feel less suffocating. Grow that investment to $800,000, and you're looking at $40,000 a year, over $3,000 a month. Financial independence isn't a distant dream. It's right there on your portfolio statement. For those adventurous, ETFs can juice their yields by writing covered calls and collecting premiums. These funds can pay 7 to 10% yields, offering dessert-level income, but with risks. If you're consistently investing $20,000 a year and reinvesting everything, you could get to $4,000 a month in 15 to 20 years. If you already have a big portfolio, you can hit the target almost overnight by shifting into income-focused ETFs. It's not about comparing yourself to others. It's about knowing your path and sticking to it. Consistency beats heroics. The winners are those who invest steadily, reinvest dividends, and let time do its work. In the early years, reinvestment is rocket fuel, but later, taking income is the payoff. A paycheck feels like obligation. A dividend feels like freedom. That's when you know the capital is working for you. Absolutely. Earning $4,000 a month is possible, but it's not overnight. It's about discipline and smart choices. The result is peace of mind, knowing cash keeps flowing even if your job disappears or you try something new. We live in a world where most dollars come with strings attached. Your boss expects output. Your hours trade for money. The first time you see a dividend or ETF distribution, it hits different. Nobody expects work or deadlines. It feels unfair in a good way, like discovering a cheat code in a game. This realization drives commitment toward financial independence. Some people get impatient, thinking their small dividends will never grow. That's short-term thinking, and why most people never make it. Remember, portfolios don't grow in a straight line. They crawl for years, then suddenly leap. Don't quit before the leap, or you'll miss the magic. The grind years are what feed the explosion years. Imagine a snowball rolling down a hill. You push and sweat, then it gains momentum. The pain is up front, but the payoff is backloaded. Now let's get personal with numbers. Start with discipline, adding $1,000 a month into ETFs. At 5% yield, that's $60 a month in income right away. But keep stacking, reinvesting. In 5 years, you've built close to 75 grand. Producing about $300 to $400 a month, that's the magic of compounding. 15 years in, you're looking at 300 grand and around $1,500 a month. 20 years in, you're flirting with 600 grand, generating $3,000 a month. You didn't win the lottery. You just showed up every month and let time do the heavy lifting. The money feels slow at first, but then it snowballs. Of course, not everyone can put in $1,000 every month. Some can only spare a couple hundred. That's fine. Progress is progress. Every dollar you put aside is a vote for your future freedom instead of today's impulse.